Yeah, you can hear me fine, right?
Yes, I hear you. I hear
Fantastic. Right. So thank you all for taking time out on a Saturday. I'll put my mug, as Jeanette calls it, on the screen.
There you are.
I love that word, his mug.
A lovely mug. Okay, all right. I'm going to give you the mic. You have an hour. Take it away.
Brilliant. Okay, so today we're going to look at what I feel is an important but overlooked aspect of the markets, and that's something I call market dynamics, or how to conceptualize and understand the kind of sheer mass of activity in the markets and the resulting moves. Now, before I do that, I just want to give you a little bit of background about me. So this is me on here. I can assure you the camera makes me look a little bit fatter than I am. I'm actually here sitting in a proprietary trading firm in London, one of the many proprietary trading firms I work with. Now, the people I work with at these firms are the traders, the management, and the people in charge of the education, trade and development programs at those firms. So I have a lot of insight into the way they develop traders. And I also work with retail traders, people at home who, you know, when they come to me year after year, they've been trying and failing to profit from trading. So as I said today, we're going to look at how to make some sense of all the activity in the markets. And we do need to make some sense of the markets. This is the results of a poll we did recently, and we came up with the following statistics. Now, we do expect that most retail traders are losing money. You've all seen the stats. But the scary statistic to me is how much time people have actually put into trading. And actually at the beginning of 2017, within a week, I had two different traders contacting me, telling them they'd been trying to trade for 20 years and were still not profitable. And to me, that's a huge amount of time committed with zero reward. And I wonder how many people in the audience today would be happy if they were still trying to figure this out in 10, 15, 20, 25 years. I presume not many. So I know that some of you here will probably have been looking already for 10 years and you want to break that cycle. The problem is you're not breaking the cycle. And without realizing it, a lot of you are probably repeating the same mistakes. Now, you're not really to blame with this for this cycle. The problem is, one of the problems is the retail education world is basically selling you what you think you want, not what you need. So a typical retail trader, they first decide that they want to trade, and then they go looking for a technique. So they show me how to trade, they say, or even let me watch you trade. So they go out, they buy a method, it doesn't work, and there's absolutely nothing they can do to improve the method. So they go looking for another method, which is the same as starting again. And they go over and over through this cycle. And in fact, that search for a winning technique is why a lot of you are here today. Now, a proprietary trading firm will first teach their intern traders how the market behaves. So typically 25% of their program, their educational program is teaching, 75% is the trader observing what they've been told to observe, or observing what they've been told about. So the students given exercises and drills that reveal to them how the market behaves, but actually gets them to experience it. So students see for themselves. You know, they're given suggestions, but not really rules on how to exploit that behavior. After 12 weeks, they're left to show that they can profit on sim before they're given a live account to trade. And the faster ones are trading live money, some as soon as the 12-week period is over, but that's kind of rare. Usually around the 6 months period is when they're finally getting onto a live account. But basically, in that 12-week trading period, it's 3 weeks of theory, 9 weeks of guided observation, and then a variable amount of practice at the end before they get onto a live account. And that's very different from all the years that we see retail traders put in. Now, the technique that you employ, or that they employ, is based on an understanding of market behavior. So if the technique doesn't work, the trader still has the knowledge of the market behavior that they need to figure out, is it just their poor execution skills that are the problem? Did they misunderstand the behavior? So with this kind of knowledge of how the markets behave, they can repair something if it's not working for them. They can actually react to poor performance. So today we're going to look at behavior, how markets behave and why. And you need to understand this as a baseline to breaking that cycle that you're in now. After all, you know, if you keep doing what you're doing now, you're going to keep getting the results that you are getting now. Now, let's just say you could go back to the first day you came across trading, you know, when you first decided to look at this giant pool of easy money and make yourself a fortune. So let's say on that day, you met a wise old trader, and that wise old trader said, nobody knows where the market's going to turn around. Now, how would that have changed the way you approach the market? Because everybody out there, if you notice, they're all trying to teach you where the market's going to turn around, right? And I can tell you, in a proprietary trading firm, they don't try to find where the market's turning around. But let's say somebody said, nobody knows where the market's going to turn around. How would that have changed the way you approach the markets? So for many traders, it would be a really big change. Instead of trying to buy the lows and sell the highs, they would have been following moves that had already initiated. So if you couldn't tell where a market would reverse, then you'd have to obviously make money some other way. Now, whether this is true or not is actually not related to fundamental or technical analysis. It's kind of a level above that, almost like a philosophical question about the markets. But how would we know if this statement was true, that nobody knows where a market's going to reverse? Well, we'd need to understand first how markets behave and why. And trading is all about understanding how a market behaves and then trying to exploit that to profit from it. But what does it even mean, how a market behaves? In fact, what is the market? Do we really understand what the market is? Well, we're going to answer those questions today, because a big part of trading with confidence is understanding whether a trade makes sense and whether the trade you're in is actually working out or not. Now, many people try and do this with statistics, trying to figure out the amount of time something happened before in the hope that that will be relevant in the future. And I'm going to commit some trading heresy here and suggest that actually statistics in trading are of limited use. And to back that up, ask yourself a simple question, right? Do you trade statistically yourself? I mean, can your own behavior be modeled statistically? Will you sit at home trade predictably and according to a rigid mathematical model if you just lost money, or if you just made money, or if you had an argument with your husband or wife, or if you have a hangover, or you're working on tomorrow's hangover, or you're stressed, or you just won the lottery? Of course not. All of those different scenarios are going to affect your trading. So I'm not saying there's no place for statistics in trading, but it's really odd that people believe the entire market would conform rigidly to a statistical model, while at the same time knowing that they as an individual don't conform to any statistical model themselves, right? Now, I don't think it's a question of statistics being bad, that we can't model trading behavior in certain ways. I just think there's a more organic side to trading that gets overlooked when we try to boil it down into something mathematical, into something like, when this line crosses over this line, do this, right? And this organic side of trading is just as important, if not more so, than the technical side. So we need to have a model or a philosophy that explains why moves occur in the market in the first place, why people buy and why people sell, but from a human perspective, not a mathematical one. And today, we're going to look at my philosophy or my belief system when it comes to the markets, my take on this organic side of the market. So what I do think is true, if you don't have any way to perceive the huge, massive traders out there that are behind the moves, that any purely mathematical or purely technical approach is going to leave you a massive disadvantage. Now, what we've got to think about is people tell us the markets are really complex. So let's try and figure out how complex does your worldview of the market needs to be. So we know that markets are very complex places. In any market, on any day, we're going to have institutional long-term investors. We're going to have hedgers, swing traders, day traders. We're going to have HFTs and algorithms, all participating in the market, all at the same time, all to different degrees, depending on time of day, news, all that kind of thing. Markets individually affect other markets at a macroeconomic level. So we've got interest rates, currency rates, all prices that all affect each other. And we've got technically related markets that are kind of joined through arbitrage, like the NASDAQ, the Dow, and the S&P 500, or Brent crude and WTI. And all of that complexity is so daunting if you believe you need to understand and model it all before you can make a trading decision. So can you trade really without knowing what an HFT did in the past 20 seconds? Does your statistical model need to take into account of all these variables and markets? Well, how about if we don't worry about what's moving the market? How about if we first consider what the result of all this complexity is? And it's simply up or down. So despite all the complexity we can bring into these markets and all these relationships, the markets can only go up and down. In fact, you can toss a coin to enter a trade and be right about the markets half the time. Random trading would basically just lose you the spread and fees. It would be a slow breed, but you'd be right half the time. But a lot of traders don't even have the win rate that's equivalent to random trading. They aren't anywhere near that successful. And there's a few reasons that many traders can't get close to random trading results, and we'll look at that as we go. But the bottom line is that, yes, the market is very complex, but the result of trading is very simple, up or down, that's all. Now, based on the complexity of the market and the number of people involved, you can see how terms like crowd psychology are really popular when describing the market. But there's two issues I have with this term and others like it when applied to the markets. First of all, there isn't one crowd. There are many different crowds with different motivations. So on crude oil, you've got people trading outright positions, speculators. You've got people trading calendar spreads. You've got people spreading Brent and WTI. You've got people hedging, airlines hedging. And those different groups of people have different goals and seek different outcomes and react to different things. So it's hard to see how those different groups of people could just be considered as part of this one crowd that we use when we use crowd psychology. They're all playing different games. Another issue with the term crowd psychology when it comes to trading is there's lots of people talking about it and they say, oh, crowd behavior, crowd psychology moves the markets. But there's no bridge between saying that and how to use the information in trading, right? So somebody says crowd psychology to you, you say, great, tell me where to get in based on crowd psychology. So we don't hear much advice on how to use crowd psychology to enter and exit the markets. It's often just a bit of a buzzword or a bit of knowledge given with little practical value. So let's try and give that some value today. And let's first consider something that I call the dominant crowd. So it's my belief in trading that we have multiple layers of crowds, but that only one can be dominant at any time. Now, I don't use the word in control. So you'll never hear me say they are trying to do this or they're trying to move the market here, because I don't buy at all the idea that the markets are controlled. And I've met traders that have been 30% of the volume on an individual market, right? And even those guys were not in control of the market. Sure, there were times where they'd nudge it around a little bit, but they were actually just going with the flow, right? So I've never, in my time, I've never met somebody who was controlling the market, and I just don't buy that. So we don't use in control, but we say the dominant crowd, and the dominant crowd can be considered the crowd or the group of traders that is influencing market direction the most, but it doesn't mean they're in control, right? So with the futures markets I trade, I consider three potential dominant crowds. The first one is long-term institutions who most of the time are asleep, or rather they're not dominant most of the time. Theirs is a long-term game, so they're not changing their minds and switching positions in and out all the time. So it often takes major economic news for institutional trading to come in and dominate an entire futures markets, right? So, things like interest rate changes, embargoes, all that kind of thing. So we often get alerted to, the fact that long-term institutional positioning will be going on a day because of planned or unplanned news releases. And institutional positioning tends to create directional moves, and often those moves are hard to join because there's not really a pullback in them. Now, another dominant crowd, short-term speculators, people like you, people like me, that are in the market to make a short-term dollar, people that really aren't interested in the underlying value of that market, but are just trying to make money from the moves in the markets. And in my markets, the markets I trade, crude oil, S&P, that's the dominant market the majority of the time, or the dominant crowd the majority of the time. Then you've got market makers and, to an extent, manipulators. So these guys tend not to be dominant unless the market's very quiet, at which point the opportunities for them to make low-risk profits by nudging markets around, that increases. And I lump in manipulators here because manipulation of markets is a lot more likely in a quiet market. Now, if you ever saw the market you trade move one way all day and you tried to trade against it, you kept, the market was moving up and you kept trying to get short, or you just couldn't join the move, that's simply you not reacting to a change in the dominant crowd. Because if long-term institutions are dominant, they're not going to behave like speculative day traders, right? And the market will behave differently. They're not going to react because of a short-term move in the same way that day traders would. And that's why these one-way days are often hard to join, because it's a different set of markets, a different set of players, volumes coming from a different place, different motivations. And, you know, a lot of traders, they simply think you can apply the same technique to any market in any time frame on any day, and they just get caught out because something that works on a speculative driven day is not going to work on a long-term institutional driven day. So the moves generated by these crowds of traders are basically different because of a couple of things. So first of all, the time that between an institution buying or getting into a position and then getting out of the position are different. And the sort of moves or the sort of events that cause them to react are different. So a day trader on the S&P 500 might bail out because the market moves down 4 points. But an institution hedging a massive portfolio position is simply not going to react in the same way. Now, hedgers and spreaders are unique in that they actually don't care what happens on one side of their trade. So if you trade a single market, you're going to react to events in that market. If you're trading a spread, so you're trading, you know, you're buying one market, selling another in a spread, events on one side of the spread aren't really that important. So again, you're not going to react to them. So a move against a spreader on one leg of a spread is irrelevant, and that's why spreaders won't generally be the dominant crowd. So their trading is not directional. They are, you know, they're kind of the exceptional, but you know, let's not complicate things too much. Now, HFTs are much misunderstood. Everybody says, oh, the algorithms are trying to do this, or HFTs are doing this. HFTs are basically market makers, and their holding times are so short that they're never going to be the dominant crowd. So their buys and sells are so close to each other that they're basically neutral. So chasing HFTs, trying to understand what they're doing is really a wild goose chase. Now, what would be a reasonable goal in trading, or, you know, when we think about the dominant crowd, what would be a reasonable goal in trading when it comes to benefiting from understanding the dominant crowd? Now, I don't mean in a percentage return. I mean a goal from the kind of individual kind of trades that you're trying to take. So let me give one goal that I hear about. Well, let me give you a crazy goal, right? So let's say one of your goals is I want to buy the S&P 500 futures on Monday. I want to put a 4-tick stop on it, and I want to hold the trade for 12 months. Now, I think we all know that's not going to work, but it's an obvious example of something that wouldn't work. So let's consider a less obvious one, a more common one. Here's a goal. I want to buy the low of the day on the S&P 500 futures tomorrow and hold it till the high of the day, because that's what I see a lot of retail traders trying to do. Now, I can't tell you that that's right or wrong. I can tell you that I've never met anybody that can do it, and I've never met a professional trader that's even bothered to try and do it. What I can tell you, though, because you've got to do what you do, is that if that doesn't fit in with your understanding of how the markets work, then of course it won't work. So for me, anything I do has to fit in with my understanding of, you know, the way that crowds work, the dominant crowd works, and how that behaves. So with that, I can validate a goal, and I can also stick with the trader under pressure. And I also need to have different approaches depending on who I think the dominant crowd is. So with my understanding of the dominant crowd, I now need to understand the kind of dynamics of that crowd, or the crowd behavior, to understand how that crowd will behave. Not in a theoretical sense, right? But in a practical, where do I get in, where do I get out sense, so that I can actually exploit that behavior. So here we have a typical day. And of course, there's no action on there. So this is how most traders start the day, or start the week, or start the month. They're looking ahead. And in this case, we've got a day where we've got very little information other than maybe some levels, maybe a low volume node, yesterday's high, whatever levels we look at. You know, and for the markets I look at, S&P 500, these are levels that a lot of people use before the day starts. Now, it doesn't really matter what market this is. The theory is the same. All that matters is that we're sitting down, we're going to trade, we haven't started yet, and we have some levels of interest. You know, I think that's common amongst a lot of traders. On this example day, we'll have day time frame speculators as a dominant crowd, because that's the case about 80 to 90% of the time. And at this point, of course, the vast majority of day time frame speculators are not positioned yet because it's the start of the day, right? So they're not in the market. So like I say, common levels of interest are noted here. different markets do have different levels of interest that are in play. This is just an example. Experience tells us that when day time frame speculators are dominant, we're going to have a number of candidates for where the market might react, or it could, of course, react in the middle of nowhere. So the levels that you set in the markets ahead of trading should be considered just potential crowd reaction points, right? They're not entry and exit points. So what happens, we move on, the day opens, and we've got this red X here. So some levels that we use in trading, we can define before the market opens, and some are going to be created based on the activity after the open. Now, a lot of this is to do with fairly basic psychology. So people win money, people lose money. Losers tend to be very wary of making the same trade again. So there's certain things you can see in the volume profile, like when you fall backwards to a place where sellers lost money, you tend to run out of sellers when you get back to that point, if it's a point where they lost money recently. So, when people see also that one side is clearly winning, they'll tend to join and ride that move. So the open price on most markets is often quite significant because it brings us back to unchanged for the day. It's only going to be relevant to short-term players though. So institutional investors, if you've got a big news before the start of the day, a lot of institutional investors coming in, they're not going to change their minds because we get back to the open. So we keep this price on our radar because, again, it's a potential crowd reaction point. It's not an entry price. So we have kind of homework, research-based potential reaction points created before we trade, and we have developing action-based reaction points when we trade. Okay, then what happens? Market moves, right? So what have we done? We've already moved up through one common level, nothing unusual about that, and now we're at another common level. So in terms of crowd, there's one concept that I find really strange in trading that some people talk about, and it's about this thing of wholesale and retail prices, right? If you watch any market and you watch a tape, as you move up, you will see there are a lot more buy market orders and sell market orders on the way up. You'll also see the largest trades are mostly on the buy side. And as this move continues up, what is it your average retail trader is doing? Well, a lot of them are waiting for the opportunity to sell. And that's despite the fact that the market has obvious upside momentum, and despite the fact the order flow and the crowd are clearly favoring the upside. So retail trader mentality is, I want to sell that, I want to sell that. And there's a few reasons for this. First of all, these kind of well-defined levels are indeed places the market may reverse. But there's an assumption that these makes the levels good places to take a trade. And the assumption is one I have never seen proven, right? So now I would just ask you to be skeptical about trading at levels, predefined levels. But anyway, we should all be able to agree that these levels are obviously not the only place you can enter. You can use levels for many things, and entering a trade is just one of them. Now, levels do, in theory, give you the most points per trade, as you stand to benefit. If you sold here and the market went down, of course, you're getting in at the best price. You stand to benefit from the whole move if you trade the extreme. So a single reversal trade gives theoretically more points than a single continuation trade, but that does not mean you'll be able to make more money trading reversals, because there will always be less reversal trades available. Now, reversal trades are also attractive because they have this very clear get out point. You say, well, I'm going to go short here, and if the market moves down, I'm going to put my stop just above the term, right? And it just looks cleaner. It just feels and looks cleaner. But it's an optical illusion, absolutely an optical illusion, because no matter where the market is, it can only go up or down from any price point. And that's true regardless of whether you enter at a potential extreme, middle of a move, end of a move, right? So anyway, what's the smart money doing during this move? So on the way up here, you'll see large trades over and over again on the buy side, 20 up on crude, 100 up on S&P. And there are people that say the smart money is just the people that bought the start of the move. And some educators call these starts of move prices, these are the wholesale prices, right? And anything after the turn, so this would be a wholesale price to sell. And if the market moves down, anything after that is just a poor retail price, and only bad traders pay retail prices and the pros pay wholesale prices. And in my opinion and my experience, that's absolute nonsense. After all, the 100 lot traders, that you will see buying on the way up obviously know what they're doing. And a move up like this would not occur unless there was a significant amount of buying on the way up. The market wouldn't move. So if the smart money only bought the bottom of a move, that would mean that only small, stupid traders are buying afterwards. And if that was really the case, the market wouldn't move up. So I'll repeat that. If there wasn't serious commitment to the upside, we would not continue to move up. And you can see this yourself. Just pull up a time in sales, have a look at the size of trades during a move, and ask yourself, is that all dumb money? It doesn't really make any sense. So when momentum is to the upside, there are smart, short-term traders buying and making the most of the move up. The people losing out are the ones that keep trying to sell the moves and the ones that are just watching it up and not participating because it hasn't got to their level yet. So let's consider how this works from a crowd behavior perspective. So we can observe that smart money doesn't just buy the extremes of a move. That's a myth. And we've also discussed that having an organic view of the market to complement any technical and fundamental views we have is going to help. And you can't get much more organic than sheep, which, as we know, move in herds. So the people that buy at the low of a reversal up are the kind of first few sheep to take steps in a new direction from the herd. Other sheep see them and move with them. And before you know it, all of the sheep are heading in that direction. And it's not a bad thing being a sheep. They move in herds so they don't get picked off by a wolf. It's safer to move in a herd. The sheep that follow aren't the stupid sheep. They're just moving with safety, not wanting to get there standing on their own. It's the sheep that don't follow that get eaten. So if your organic view of the market fits with the sort of herd behavior we see in sheep, and if you think about how and why sheep move, it doesn't seem that smart to always try to be the first sheep to move in a new direction. Now, a lot of times, a few sheep, if you can see at the bottom right here, a few sheep will move out of the herd and nobody follows. And, we have a few counter-trend sheep there at the bottom right there, fading the herd. But the chances of those guys successfully swinging the herd their way at this point is quite low. And basically, you as a retail trader, it's not your job to turn the market around, right? So these are the counter-trend sheep that in a clear move up are trying to sell the market. So the sheep analogy for trading crowd is much closer to the truth than this wholesale retail analogy, which falls apart when you just consider the sheer size being traded during a move. It makes a lot of sense when you watch the order flow too and see how real size is following a move up. So anyway, our day moves on, and now we've got what looks like a turn, or it could be a pullback. And which is it? Is this a few sheep going against the herd, or is it a new move down initiating? Now, before we answer that, it's worth having to think about why pullbacks occur, or sometimes why we might actually need a pullback. Now, in a move up, we've got sheep initiating long positions, but these sheep are not buyers, right? They have already bought. Anybody that bought on the way up is now a potential seller. They have to sell to take profit. So in a move up, you've got a combination of two things occurring. First, more and more of the sheep have already built up a position of the size they're comfortable with, and they just don't have the margin or don't want to buy anymore. And second, some of the sheep start to take profits. So what happens is you naturally get a push down. And when you get that push down, one or two things is going to happen. And this is going to be fairly obvious. So either after some small amount of selling, the market starts to move up again, and then the sheep quickly re-engage on the long side. So basically what we've done is we've managed to shake off a bunch of future sellers, stale longs. People can see that the pullback held, and sheep see safety of the herds on the long side, and then you just start to see the buyers pile back in. The long trade is the one that will attract the most sheep. Now, of course, the alternative to that is sometimes more and more sheep will sell, and this will continue until the sellers overwhelm any remaining buyers. More and more sheep see that and believe that now the opportunity to the downside, the herd has shifted. So as traders, what we're doing is we're watching this play out. Just like all those sheep, we're trying to assess the movement of the herd. Is it directional? Is it fading away? Is it just moving sideways and stop moving? Now, one of the issues that people have with this is it's very common for traders to see themselves as one thing and the market as another. And a good example would be like you're the climber and the market is the mountain. So you're trying to climb the mountain. Now, what's a little bit harder to conceptualize but much more beneficial, is as traders, we're all just simply sheep in the herd. You're a sheep. All of the other traders are sheep. The HFTs and algorithms, they're also sheep. We are all sheep. So you and the market are exactly the same thing. And as traders, we have to accept that the market is primarily made up of many participants trying to figure out what everybody else is trying to do, either short-term and long-term. And let me just repeat that, right? The market is made up of a bunch of people trying to figure out what everybody else is doing, right? So when you look at the market as this thing that's separate from you, you instantly negate all of your own experiences of playing that market. But basically, this process of everybody trying to guess what everybody else is doing, that's what's creating the moves in the market, right? And it's a bit of a kind of tricky concept to accept. But there is no market, right? There is no the market. There's just lots of people and machines all trying to take advantage of each other. Now, as we discussed earlier, if I told you that I could give you a mathematical formula that would predict where you would buy and sell today, you know, if I said, right, at 9 o'clock, you're going to buy that market at that price. At 12 o'clock, you're going to buy this market at that price. If I told you that, you said, no, you're crazy, right? Even I don't know what I'm going to do. Nobody knows what they're going to do before the day starts. But lots of people want to believe that some mathematical formula can predict whether the sum of all participants will change direction on any given day. Now, considering yourself as a trader, how on earth is that math working exactly? Because if it can't work for you, how is it working for everybody? You know, if it's not predicting your own personal behavior, then how can it predict the masses? So let's presume for a second that nobody knows where the market will turn. And let's actually not just accept it, embrace it, that we don't know where the market will turn and that nobody does either, and that you don't actually need to make money. It's just sheep, and there are simply too many sheep and too many variables to make that kind of accurate prediction. Now, it doesn't mean that trading is more difficult. This does not mean that trading is more difficult. It just changes how you make money from the markets. So where do levels come in? You know, people use levels. Well, a good level is one that is really well known. So if you've got, if you ever go to a website and you see things like, we got some secret levels, you know, you see these websites, you know, secret levels, and it's like, well, if it's secret, the sheep will not react. If nobody knows about a level, the sheep are not going to react there. And even with well-known levels, the sheep might just ignore it this time round, but take notice of it next time round. It's kind of random. What we do know is this. When a market reverses off a well-known level, the sheep are more comfortable going with that move. And that's where levels really help you. Now, a move off a key level, like yesterday's high or yesterday's value low, is more likely to continue than a move out of nowhere, right? It just helps with bias. So levels are great, you know, but trying to initiate trades exactly at your levels and expecting the market to reverse there, give you a 10, 20, 50 tick trade is just really low probability. And that's not what professional traders do. The other problem with trading at levels is you will always be trying to be the first sheep, right? You're always selling when the market's moving up and buying when the market's moving down. But you can still get a good trade. But you don't actually need to trade at the exact turning point. Why do you need to be the first sheep? What is the upside in being the first sheep? More ticks on an individual winning trade, true, but bigger losers and more frequent losers and less frequent trades, right? There are just simply more continuation trades available than reversal trades. And this is what many retail traders are doing. They're trying to predict where the crowd will turn. Professional traders, they're simply trading what's happening in front of them. You know, when you try and trade a major turn, you are trading against momentum. The market's moving one way and you're trying to predict a sudden mass change of mind across the market. Now, at some point, we do need to confirm that any counter trend move is a reversal or not. And if it is, there should be sheep activity telling us that it is. On a reversal down, you'll generally see market sellers outpacing the market buyers 1.5, 2 to 1. Volume on a push down will be relatively high if it's a new move initiating. And the size of a push down generally should be larger than any of the pullbacks on the way up, right? If it's a market's reversing down. In other words, you're going to see a different kind of move when the market's reversing and a different kind of participation with the market's reversing, right? That is, of course, if day time frame speculators are the dominant crowd. And we also already talked about big news, big volume, single directional move with few pullbacks. That kind of indicates that the institutional players are in charge of the market, right? But until, you see these things happen, until you can actually see that, yes, there is the sheep have turned around, you have to be really careful trading reversals because you might just be seeing a few wayward sheep. So where levels really help is when a reversal occurs near a well-known level, it tends to attract more sheep. It gives people a bit more confidence to join a move, and it helps you confirm that direction has changed. So back to our example. We're now, excuse me, find my cursor. There you go. The curse of having too many screens, right? Back to our example. We're now back to the open. Another potential reversal point, or in my opinion, another place where a bounce could bring in sheep. So once again, is this high the only place in the move down where the smart money entered, right? Is this the only wholesale price and all the price on the way down were just dumb retail prices? Because if so, who are the people throwing in all those 100 lot orders on the S&P, 20, 30 lot orders on crude on the way down there? Is it just dumb money? If we enter long now on the way down, what's the chance we're going to get trampled by sheep? So if you think of the market as a herd of sheep, you think about exploiting different market behavior. The hard strategy is you're trying to be that lead sheep because quite often you'll be out there in front and you'll look behind you and you'll see nobody's following you. So being the lead sheep is enticing because you get to enter on one of these nice turns sometimes and put your stop above it. And being a following sheep, it just means entering with momentum. It's not a sexy trade. But there are many more momentum opportunities than reversal opportunities. There's no concept of miss the turn, miss the trade. So when you think about the market as a herd of sheep, you are actually embracing the uncertainty that comes with trading. You can have your levels, but you don't need them to hold to the tick. They're simply potential reaction points. And when a move's underway, small pullbacks, iceberg orders, high volume nodes, they all give you opportunity to enter with tight risk as long as the sheep is still on your side. Now, sure, these might be new locations to average candlestick trader, but they're not that hard to spot. It's just a different approach. Now, most retail traders are searching for a sure thing, and usually a sure thing that has them guessing where the sheep will turn and thinking that anything after that is too late. But searching for something that works for 10, 15, 20 years, from what I've heard, the traders I've met, it's a soul-destroying experience. I talk to people and they've been so beaten up by trading. I'll say, where do you want to be in trading in the next 12 months? And I'll say, well, I'd like to break even. And it's like, man, 12 months and you want to break even? It's like, go and work at McDonald's. You'll get more money. Now, most retail traders, the basic problem is they want to be given a few simple rules they can trade forever. The problem is they never find those rules because they don't exist. But what traders really need to know is just to learn how markets behave and then to exploit that behavior. So traders that understand how the markets behave will evolve with the markets. They can see the change in the markets. Traders that want to buy trading rules will just bounce from one system to the next until they give up. So what we talked about today is not really about easy or difficult. It's simply about having a more rational perspective as to what's going on in the markets that you trade, right? We're not talking about trade setups today. We could talk about trade setups, but obviously we've just got an hour and I really want people to start thinking differently about the market. So in many ways, good trading is just about going with the flow. And I know professional traders and their biggest trades are just when the market takes off, they just trade with it and scale into a bigger position. It's just taking the path of least resistance. It's about specializing too in something with a high probability of working, and that's how you become a better trader. So it's not really about finding this perfect entry because actually the techniques you use to enter the market are actually fairly simple, right? But what a lot of people do is they'll try a method of entering the market. They won't be very good at it, and then they move to the next. And what they should do is actually specialize in that entry, consistently reviewing the results, making sure that your experience trading that particular entry becomes a learning experience and actually master it, right? So one of the problems with trading, one of the fundamental problems with trading, I give you a profitable setup tomorrow and on Friday you'll have given up. Because if that profitable setup, for instance, has an 80% win rate, your performance as a trader will not match the maximum win rate of that setup when you start using it. It's impossible, right? So if it's got an 80% win rate, you might start off at 30 or 40 and think after a few days that it doesn't work, right? And that's what I mean about actually specializing, sticking with something and specializing in that thing. But it's got to be something that's rational and agrees with and fits in with a rational worldview of the market. So you can take a basic setup that is grounded in reality and not grounded in fortune telling, get to the point where you can trade that setup, and then you can analyze the results of your trading and feed that back in, so you're learning from the results themselves. So instead of trying something for a few weeks and moving on, getting a very shallow knowledge of many techniques, you learn something that works with the understanding that it will take time to make that work for you. You basically specialize and you improve over time. So even the traders I know that make tens of thousands of dollars a day, and I do know traders that make that kind of money, at the end of every day, they are going over those results, making sure they maintain and improve their edge. Now, for sure, the intern traders are doing a lot more of the review, but the good traders, they're still reviewing their results at the end of every day, and I know this because I work with them. Now, at Jigsaw, we offer the only complete solution that I know of to real trader development. So our educational content is second to none. I hope you appreciate what you've listened to today. It's probably a bit different from what you've heard before, but I do hope that you appreciate it. This is pretty standard to the kind of materials that we actually teach at Jigsaw. We have educational materials, as I say, it's second to none. We have proprietary trading firms using our trading materials, and we offer very low price trading that will keep you going in trading for years, because it's not an all or nothing thing, right? This isn't something where you're going to sit at home over the weekend with a bunch of videos and then on Monday you'll be trading it successfully, right? So we wouldn't even recommend you watch all the videos. It's about having techniques you can layer in one at a time in a process of consistent improvement. So one of the things that we look at, so for instance, you might take one of the edges in the market, for instance, trading iceberg orders or trading volume spikes, and you might work on that and then perfect that so you actually become profitable with it. And then you might say, right, I'm now actually going to introduce some advanced trade management techniques. And that would be a completely separate set of skills. And it would take, and you would need to spend time to learn those. And that's what we believe in, is layering in techniques on top of techniques. Then we've got trading tools. We have our own trading platform. So we've got award-winning tools voted best in class by retail and professional traders, giving you basically professional level tools, focusing just on what professional traders that we work with focus on in their trading. So if your platform right now has 300 indicators and is written by a bunch of nerds that can't answer questions on how to trade, then using our platform is going to be a very different experience. Then the analytics, which you can see at the bottom. Very amazing analytics, world-class, brand new product, tracks every trade you take in real time, giving you the chance to kind of slice and dice your trading information when you do your daily, your weekly, monthly reviews, to really find out what's working and what isn't working. Because the way you're going to make trading work is to do more of what works and less of what doesn't. There is no magic bullet. It's about you get to one level, you then improve, get to the next level. Now, there's two packages we have. All include lifetime access to the trading platform, the analytics, and our daily live chat room. And the independent package has got 10 hours of the best order flow education available on the internet. And the professional's got an additional 7 hours, which covers specialist topics like scalping, trade management, trading summer markets, things that you're going to come back to again and again. So like I say, you might start off with techniques to refine your trade entries. A few months later, you might want to come back and look at advanced trade management techniques, scalping techniques, and they're all available in the professional package, allowing you to grow as a trader progressively. And today, to that end, we do actually have a really special offer, something we've never done before, and we're just going to let this go for 2 days. You can get the professional package with us today for the price of the independent, which is a $300 saving. So if you're interested in that, go to jigsawtrading.com/TradeThirsty. It's going to be there for 2 days. It gives you a chance to go and Google me, Google Peter Davies Trading. You can see the reviews. You can find out we're the real deal. If you are serious about your trading and want to start on a path of real market understanding and how to actually exploit the moves in the market, sign up today, and I'll see you in the chat room on Monday with other Jigsaw users. And with that, I will go through the questions if I can figure out which ones are for me. I'll work from the bottom up because I'm not sure which ones are mine. Okay, cool. I'm having a bit of trouble. Okay. So with no clear methods to quantify the random behavior of the crowds and the impact on the market, how any system, platform or education program will help the real trader? Well, first of all, Matt, what we talked about today is that the market is a crowd, is like a crowd, a momentum based thing. And of course, there are methods where you can take advantage of that. What we're talking about today is really what you shouldn't be doing, which is this whole thing about when this line crosses over this line, do this, or here's this magic support level, buy it. We're trying to move people away from that. Then of course there are ways to enter and exit the market. The pro version, its data feeds are CQG, Rhythmic, IQ feed, Gain Capital. I would absolutely agree. So it's not all about knowing, it's about probabilities with money management. I would absolutely agree, Bill. It is probabilities, and the lowest probability trade is trying to buy the low of the day. If I go up, what account size is recommended to trade CL and ES with your program? Well, basically what we do is, here's the way you do it with trading, right? So first of all, if you can't make money on sim, you shouldn't start. And when people say to me, Pete, when can I move on to sim? I say to them, okay, let's just say you've got a friend that's not profitable on a live market and he's asking you for $10,000 to trade. What would you need to see from him to give him that $10,000? And basically, so we recommend that people start, where you need to get to your sim trading is, and where the prop firms start, is they're looking for traders to trade 1 or 2 contracts and be looking to try and get $200 to $300 a day consistently, with no daily drawdowns exceeding $1,000. When they then get to a live market, with a few exceptions, like, I mean, there are exceptional days, but basically the trader is expected to trade 1 market, 1 or 2 contracts, and to never draw down more than $1,000. So, you're not looking at massive money, but you've got to be able to do it in sim first. You've got to give yourself, I mean, I tell people, nobody listens to it, but I tell people to create a set of rules for going live and give it to the wife. And I don't think I've ever had a single man agree with that. But I wouldn't, the problem with the retail trader is there's nobody to look after you. So, account size, 1 or 2 contracts. If you've got 5, 10K, you're okay, but you've got to make sure that you can do it before you go live. What does the Jigsaw Analytics contain and equip to the retail trader? We've got a whole bunch of stuff. We've got online journaling. We've got a whole bunch of different statistics for trading. We let you do like what if analysis. So what if I didn't trade this market, or what times a day am I losing money, or what if I didn't take this particular kind of trade, all those kinds of things. There's actually a calendar as well, a P&L calendar, which is a really useful thing, because again, what prop traders, interns are really focused on from the start is keeping green every day. If you can't get it green every day, you're not going to be able to go up in terms of clip size. So it's basically just a set of analytics that are based around the way a prop firm manager would actually assess a trader himself, right? Let me just go up. Will there be recording? Okay, I think we've got through all of the questions. All right, so I really like to thank you for listening. I know it's Saturday, so I really appreciate that you've stayed in. Jeanette, I think we can go back to you.